honestly, some people are optimizing for different things, right? Some people may be optimizing for profits today. Other people may be optimizing for equity value.
Vance Spencer had a great chart on Twitter talking about the idea that as gold runs up, Bitcoin stayed flat in 2020. Gold obviously saw a drawdown there, and then Bitcoin had a massive run. We're in a similar setup here for 2025. Do you see something similar happening moving forward?
The data's not perfect, but 2020, just for people to understand, gold basically peaked and then it cooled, right? So gold had this big run up, kind of ran first. And if you remember, let me set the scene in 2020. If you go back to March of 2020, asset prices sold off aggressively because there was a liquidity crisis. I think March 12th was the big day that Bitcoin went down 50%. I was curled up on the couch. I just don't feel too good. But then all of a sudden, here comes the monetary bazooka, right? Trump was out there posting away on social media. You had the Fed stepping in. You had fiscal policy. They were printing trillions of dollars. I remember tweeting saying you can't print trillions of dollars and not get inflation. And people were like, you're an idiot. You don't know. Inflation is transitory, all this stuff, right? Obviously, what happened is we got this massive recovery and everything took off. Now, when that occurred, gold actually was the global alarm system. Gold ran first. And you can pontificate as to why. My guess is probably people were trained, hey, money printing, gold runs. But there was two people who came out in 2020, and they pretty much started the Wall Street adoption of these assets. Stanley Druckenmiller and Paul Tudor Jones. They both came out and at different times said some effect of, we like it and we own it. Talking about Bitcoin.
Two legends,
right? And if I remember correctly, Stanley Druckenmiller said that in 2018, he called up PTJ and he basically, they were talking. I can't remember who said it to who, but one of them said, yo, you know these maniacs, 85% of them that owned it at $20,000 a coin, they're still holding it at $3,000. And I think it was like PTJ said that to Druck, and Druck was like, I'm buying. And he just went in. He was like, yo, these guys are maniacs. I'll continue to say it. Stanley Druckenmiller is my favorite investor. Why? He's basically a retail investor just with the GOAT track record, right? Like the guy, he buys, then he researches, right? If he's got conviction, he goes all in, right? And so he ended up buying. Now, it waited until 2020, and then he came out and he said he owned it. Paul Tudor Jones was on CNBC, and he had a famous line. He said he believes Bitcoin's going to be the fastest horse. That got a lot of headlines. That got a lot of attention, whatever. Gold runs first. Bitcoin kind of hung out around $10,000, $8,000, somewhere in that range. All of a sudden, the gold run got exhausted. There was now not as much demand because so many people have been buying gold, and you had gold kind of turn over and cool off a little bit. Still great, right? It was good inflation hedge. But once that turnover happened and you start the cooling off of gold, Bitcoin, then that was pretty much the inflection point. Bam, here we go. And we went from 10,000 to 64,000 in less than 6 months. Game time. It was awesome. We all had a lot of fun. Now we have a very similar setup. Gold is up significantly. It's up over 50% in 2025. People are like, wow, that was crazy. But it looks like it's peaked and starting to cool off now. And all of a sudden, you're now starting to see Bitcoin get a little bit of momentum to it. And so the question is, or what people are insinuating is there some relationship where once gold runs first and then it peaks and starts to cool, is that the catalyst for the Bitcoin, right? The great rotation from gold to Bitcoin. I did hear a pretty interesting anecdote. I have heard, I don't know how to confirm this, but I have heard that there are people who are showing up in like the Diamond District here in New York with all kinds of jewelry and stuff, that like gold jewelry, because now all of a sudden it's, $4,200 an ounce and they're just turning it in and there's like lines and stuff. I don't know if this is true. Like, we'll have to find somebody to try to confirm this, but that would signal to me the gold run. If people are like turning in the gold, right, in order to get dollars, then you basically just get the satisfaction of the demand. And so if that's the case and Bitcoin runs from here, it'd be a repeat of 2020. I don't like to extrapolate off of, kind of one single data point. But when you line the charts up, it looks awesome. Like, it looks like Bitcoin will go up. So let's see what happens.
There's USDC, there's USDT, and there's a few other ones as well. I have noticed through talking with different people that USDC extremely popular domestically. USDT is actually extremely popular internationally. Why is there a difference? And should there be a difference moving forward? And how are people thinking about this?
Well, I think that in most industries, what you get is when there's competition, people take different go-to-market strategies. They position themselves differently. They try to go after different customers, right? It's all kind of a corporate strategy at the end of the day. And honestly, some people are optimizing for different things, right? Some people may be optimizing for profits today. Other people may be optimizing for equity value. Some people may be optimizing for short-term versus long-term, right? This is kind of classic corporate strategy competition in the business world. I do believe that Tether is the king and will remain the king for a very long time, right? So I think that USDC is a very formidable competitor in terms of coming onto the scene and being able to build a business and use kind of their strategy. But Tether was first. That first mover advantage is really hard to unseat. And also, frankly, I don't think that people really give enough credit to Giancarlo and Paolo and the team at Tether. Like, these guys are the definition of competitors. And it's not just about were they early, were they the first to kind of find product market fit, but they have kept their foot slammed to the gas pedal and they are not going to relent. And so it's really hard to compete with somebody like that. Now, I do think that generally what you have seen is USDC has said, well, we're going to go and be a highly regulated, domestic-based, domestic serving stablecoin, USDC. Now, what they did to do that was they created a stablecoin and then they struck a partnership with Coinbase. And they basically said, why don't we get mass distribution via partnership? Well, if you are going to partner with somebody in that way, you've got to give up some of the economics. And so I forget the exact split between Circle and Coinbase, but if I remember correctly, I think actually Coinbase takes more of the economics than Circle does on the interest that comes from USDC, or it's at least close.
So you had another line in your letter about the idea that like people won't know the difference between centralization and decentralization moving forward. What did you really mean by that?
Well, right now, Coinbase, I just use them as the example we've been talking about. Coinbase has a centralized exchange. They also have centralized services, right? Things, lending, etc. They are simultaneously embracing decentralization. And so in the Coinbase app, remember, DeFi Mullet, business at the front, party in the back. The business in the front is the interface is Coinbase. If you trust Coinbase, you trust it regardless of what service you're using on there. But on the back end, the quote unquote party, they may be having a centralized infrastructure for some products. They may have decentralized services or infrastructure for some products. They may actually offer the same service and there's a centralized version and a decentralized version. And you may not even know what the difference is other than they tell you, well, you can earn 3% here or you can earn 5% here. And the way that they're getting the 5% is because there's decentralization, there's lower cost, there's more liquidity, whatever, right? So that to me is why people are ultimately not going to even know whether it's centralized or decentralized. A great example is how many people use the internet every single day and could name the 4 or 5 protocols that make the internet work. Maybe someone, if you went to like a bar, right? And you do like on the street interview and you ask people, what are the 5 protocols? Maybe somebody could pull out of their head HTTP, right? Maybe because they typed it once or twice in their life, right? But outside of that, like it's just not something that people understand. They don't need to understand it. All they need to be able to do is go to google.com and type in a box. Right. And eventually they're going to have a computer in their brain where they just think about it and they get the answer. They don't care about protocols. They don't care about infrastructure. They don't care about all this stuff. Let somebody else solve that stuff. Just get me something that's better, cheaper, and faster. And that's what's going to happen in finance.
I'd go far as to say that if you ask people what WWW stood for, most people wouldn't know.
I think people would just be like, oh, yeah, I agree.
You had an excellent piece this morning in the Pomp letter about the DeFi Mullet. What is the DeFi Mullet?
When he was talking, he basically described it as the easy Coinbase experience on the front end, the interface, the thing that you use from a technology standpoint, but DeFi in the back. And what it got me thinking about is kind of the collision between this crypto world, Bitcoin, stablecoins, all this stuff, with the traditional financial system. And historically, I think that Bitcoiners and kind of the crypto community thought that these were parallel systems. And in some way, they have been until recently. But now what we're seeing is the convergence. And actually what we're finding is that convergence between these two systems means that one, the crypto industry is dead. It is RIP, see you later. Within a decade, you're not going to be hearing people talk about crypto. Instead, what you're going to start hearing is people talk about finance. And my example that I used is, let's take, for example, BlackRock. I keep saying, is BlackRock a Bitcoin company? No one's describing it as that. They're just a financial institution, right? Is Robinhood a crypto company? Well, nobody describes them that way. They would talk about a fintech, a neobank, brokerage business, whatever. But they're starting to incorporate all of this infrastructure. They're looking at stablecoins. They're going really hard into tokenization, right? Prediction markets are kind of crypto adjacent. All that stuff is coming. So my point being that whether you are a hardcore crypto company or a crypto native firm like a Coinbase, Kraken, a Gemini, a Binance, whatever, you're trying to get the legacy assets onto your platform. So now you're looking at tokenized securities and stuff like that. If you're one of these fintechs, what you're trying to do is you're trying to sit with, we want a digital native experience for people who, want to use these kind of new types of products, but we also want the legacy system. We want crypto assets and public equities and prediction markets all to sit in the same place. The legacy guys are the most interesting to me because they have really big customer bases. They have trust. They're not new. They've been around for 100 years, some of them. And then because of that distribution, they can rip out their plumbing, change it into this new decentralized or kind of crypto-centric stuff. And if the interface stays, business in the front, party in the back, the business in the front, the interface stays the same, people don't even know. And so if you really think about use stablecoins as an example, to use a stablecoin today, you have to understand what a wallet is. You have to understand how wallet addresses work. You have to, in most cases, copy and paste a wallet address, check it. Your heart pumps a little bit. Like, hey, let's make sure I don't mess this up. Maybe send a test transaction. Sometimes you have to decide which network am I going to send it on? Am I going to go with Ethereum or Solana? Am I making sure that the wallet matches the blockchain that I'm going to use? All this that's insane. That's like dial-up internet stuff, right? No one is going to do that. There is nobody in the real world outside of the crypto industry that wants to do any of that. What they want to do is they want to send, receive, and hold dollars. I don't want to hear about stablecoin. I just want to know dollars. Guess what? Nobody calls them electronic dollars in your bank account. They just call them dollars. There's no delineation between physical dollars and electronic dollars. They're just dollars. Right now, we still have a delineation between electronic dollars and digital dollars or stablecoins. So if you go all the way back to 2017, I used to say two things that I said a lot, and then I realized it was going to take a lot longer, but I now think now's the right time. Let me bring it back from the archives. I used to say tokenize the world. And people would be like, what does that mean? It's all Bitcoin. And my point to them was Bitcoin is the first asset from the legacy system that we have tokenized. Now, it is a crypto native asset because we didn't take like gold, put it into an SPV and tokenize the shares in an SPV. All we simply did is we said, we're going to create another asset that is digital native that has sound money principles. Outside the system, no one can create more. Gold, bam. Bitcoin comes along, $2-3 trillion asset, we're winning. Great. Second is now stablecoins. Nobody thinks that stablecoins are controversial in terms of violating the ethos of Bitcoin, right? I don't hear anyone being like, oh, look at these shit coins. All they're talking about is stablecoins. So we took dollars and we digitized them. If you look at the transformation of financial markets, we had analog assets. We had physical dollars. We had physical stock certificates. We had physical deeds to your home, right? We had physical bonds. Used to literally, right? It used to be a thing. You would put it in your filing cabinet. It's crazy. Then we transitioned to an electronic world, and every physical asset became an electronic QSIP. Those electronic QSIPs now get whipped around these centralized databases, and that is what we know as finance today. So there was an analog era that transitioned to an electronic era. If you go back and you look at things I wrote almost a decade ago now, I talked about we are on the precipice of a change where we went from analog to electronic. We're now going to go from electronic to digital. I was really off on the timing. I thought that stuff was going to happen in like 2018, 2019, 2020. It's now 2025 going into 2026, and we're now just starting to see early signs of it. So it took almost a half decade longer than I thought. That's okay. It's here. And so what we're now going to see is every single one of these electronic assets going to transition into a digital asset. So you're going to see stocks, bonds, currencies, and commodities all get tokenized. But the thing that people don't realize coming out of the hardcore crypto world, where there's lots of tribalism and controversy and shit coining and all that kind of stuff, is this is just taking the exact same asset that already exists, and it is just changing the form factor someone's going to hold it. So rather than have a physical stock certificate or an electronic stock certificate or a share, you're now going to have a digital one. it's still a stock certificate. So you have to underwrite the underlying asset itself. Is this a good company? Is it a bad company? Am I being diluted? Do I have a claim on cash flows? Am I going to get dividends or not? All that stuff is actually the analysis.